My name is Nikki Johnston, and I'm with Transition Advisors. Our webinar today is Mergers of Accounting Firms, the why, how, and with whom to affiliate. Before we begin, we need to cover a few important items. First, please close any other programs running on your computer. This will help to ensure quality presentation and reduce any audio issues. Transition Advisors, LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. In order for you to receive your 1 CPE credit for today's webinar, you must complete 2 requirements. The first is that you participate in 3 out of the 4 polling questions that we'll have throughout today's presentation. And please note that GoToWebinar does monitor your participation in those polls. Next, you'll need to complete an online evaluation of the webinar. If you registered for today's webinar through Transition Advisors directly, you'll receive a link to that online evaluation in an email from me later this evening. Once both of those requirements are met, the CPE certificate will be emailed to you within 10 business days. Now, in order to fully participate in the webinar, take just a moment to familiarize yourself with the GoToWebinar control panel. It should be on the right-hand side of your screen. There's an orange arrow near the top of the control panel that you can use to minimize it. During the presentation, all of the participants will be muted, but you can communicate with us by using that question box toward the bottom of the panel. Just type your question in the box and click send. Questions are important to us, and time permitting, Terry will answer all of your questions during the session. If we have any questions left over, we'll be sure to respond to those over email. Now, you should have received a link in your reminder email to download a copy of today's presentation if you'd like to follow along. If you registered through CPA Academy, the link in your email may have been an incorrect one. I just sent the link out via that chat function of GoToWebinar, so you can click on that if you'd like to download the PDF and follow along. And you can also request a PDF of the slides via email after the presentation if you'd like as well. Now I'd like to introduce our presenter for today. Terry Putney is the CEO of Transition Advisors. Thank you so much and enjoy the webinar.
Thanks, Nikki. And we may be just a little bit delayed getting, if you've attended our other webinars, we usually get our CP credits out almost immediately after the webinar. This time we may be just a little bit delayed due to some scheduling issues we have internally. So, but we will be within that next 10 days. So if you're used to getting a little quicker, please be patient this time. Again, Nikki introduced me. I'm the CEO of Transition Advisors. We're a national consulting firm that works strictly with accounting firms on issues related to the ownership of an accounting firm. Those issues fall into 3 main categories. We are involved heavily with mergers and acquisitions. We arrange for parties to meet each other and support the transaction all the way through to closing. We work on a lot of transactions nowadays where the parties have met each other already, and we just provide support to the parties in how to get the deal done. But we're also very involved in searches to find either firms to acquire or firms that would acquire a firm seeking to be acquired or merging upstream. We also work significantly on succession planning, which oftentimes leads to redoing ownership agreements, partnership agreements, shareholder agreements, and so forth. That's a huge issue right now in the profession, as there are a lot of firms that have out-of-date agreements that might have been written 20 years ago when the firm was in a completely different situation. Or the other day I worked with a firm that had 7 partners that had never had a partnership agreement and was facing the prospect of several of their partners leaving over the next several years. So we're running into that kind of scenario as well. We do work on a national basis. We have people staffed throughout the country. There's about 12 of us total in our company. So with that, we're going to launch right into a polling question so we can get an idea of who's on the line. And Nikki, I'll turn it back over to you.
Okay, you can see the polling question there on your screen. How many partners are in your firm? Your options are 1 to 2, 3 to 8, 9 to 20, or 21 plus. And we'll give everyone just a few seconds to answer this first one. Again, keep in mind you have to do 3 out of the 4 polls in order to get your CPE credit today. Okay, Terry, I'll go ahead and close the poll there. It looks like 76% of the folks on the phone have 1 to 2 partners in their firm, and then 16% are in that 3 to 8 range, with the remaining 5% 9 to 20, and 4% of the folks are 21 plus.
Okay, so you give me a good idea of who's on the line and what might be of interest to you. We're going to start off, and we're going to use a case study throughout this webinar of this is kind of a composite of several firms that we've worked with, scenarios that we typically run into, and use this case study as an example of some of the issues that we typically run into and how they're dealt with. In this particular case, the firm that's seeking to be acquired is a firm that has 3 partners. It's about $2.5 million in fees, with about $800,000 in capital accounts or accrual basis equity. Frank, who's the oldest, is 63, and he owns 70% of the equity in the firm. He manages about a little over half of the fees in the firm, and his compensation is about $450,000. Alice, who is one of the 2 partners, is 55, and she doesn't really have any retirement plans in the future. She's thinking, well, at least 10 years probably. She owns 25% of the equity in the firm and manages about a third of the firm's volume and makes about $275,000. And then Dan, who was admitted recently as a partner, only has about 5% of the equity and manages about $300,000 in fees, and his comp's about $150,000. So, because Frank is near retirement, he's thinking maybe 3 years or so, they needed to start thinking about how are we going to deal with this. And they do have a buy-sell agreement in their firm. In that agreement, the terms are that the capital in the firm would be paid in the first year, by the end of the first year, meaning if we go back to thinking about, Frank's 70% ownership of $800,000 worth of capital, that's about $560,000 the firm would have to come up with at the end of the first year. And the goodwill portion of his buyout, which is based on evaluation of the firm using 1 times revenues, is to be paid over 5 years with 6% interest paid on the deferred amounts. Alice and Dan kind of ran the numbers and said, you know what, I don't think we can afford this. And plus, we don't even have anybody to replace Frank, and I'm not sure we can even take on his clients. I mean, Dan certainly isn't experienced enough to manage that size book of business, and Alice feels like she's pretty much full already. So needless to say, they have a conundrum, and that's leading them to thinking, well, maybe we need to do something externally here. We can't handle this through our buy-sell agreement. The reasons why firms seek to be acquired or merge up, about 90% of the time we run into, 90% of the time, the firms that we work with, there's a succession issue that's driving this. It isn't always the only reason. It's very often it is the only reason, but very often it's one of several reasons. But somebody in the firm is uncomfortable that they can deal with the retirement of the firm's partners that are nearing retirement. Roughly 70% of the accounting profession right now is owned by people that are 55 years and older. It's a huge demographic problem within our profession. It's not just the accounting profession that has that issue. It's really small business in general in the United States. If you look at your client base and you think about who owns your small businesses that you do work for, they're primarily owned by people that are in the same position. But obviously we're focused on accounting firms today. But the succession issues, oftentimes we're looking at the strategic goals might include expanding the reach of some special services. I mean, we developed this niche. We don't have really enough clients. We feel like we could serve a lot more clients with that niche if we had access to them. Maybe if we merge into a larger firm, we'd have ability to cross-sell those services. Sometimes it's just because someone's got in a situation, oftentimes administrative duties. They're the managing partner, or not really the managing partner, but people call them that. It's primarily an administrative job, and they really don't like doing it anymore. Don't like hassling with hiring people and all the other issues associated with running the business. Sometimes it's to reduce risk. Those risks can be things like a lease or other potential loss of employees, and then finally increase the potential for professional and financial growth. Oftentimes I'm sitting here, I feel like I'm kind of hemmed in by this small firm. If I was in a larger firm, I could probably do a lot more with my career. As I mentioned, some of the things that firms are oftentimes looking to avoid with respect to risk might be, well, for instance, liabilities to former and soon-to-retire partners. Again, I worked with a firm. I'm working with a firm right now on the issue of a partner agreement, and they owe 3 of their partners roughly about $50,000 a month for the next 10 years, and really are feeling like it's really burdening them down. They're trying to figure out a way to kind of find somebody that can help them take that load off of them, as well as deal with their partners that are retiring soon. Specialized services that might be unsustainable. I ran into a recent situation where a firm had developed a very significant, very narrow niche of providing IT consulting to long-term care facilities. The partner that was running that practice had been extremely successful, but no one else in the firm could do that. And the thought was, gee, if we ever lose him, we're going to lose that significant portion of our practice. They ended up merging into another firm that could take that risk off of the table. Lease renewals, obviously, if we're looking at, you've got a lot of older partners and lease is coming due and we're going to need to sign 5-year or longer lease, maybe now's not the time to do that. Again, a potential loss of key employee. We've relied on somebody for a long time. If we lost them, we'd feel like, how would we ever replace them? And then the potential loss of key clients. Oftentimes, these are very large clients that a loss of their business would be devastating to the firm. Let's move from that into another polling question. Nikki, get another one out of the way here.
Okay, the second polling question is on your screen now. This is about your current level of interest in M&A. So here your options are experienced and currently looking, never done a deal but actively looking, not sure if we should but are intrigued, and just not sure. So we'll give everyone just about 15 more seconds to select their answer here. And again, this is our second of 4 polling questions. You must do 3 out of the 4 in order to get your CPE credit today. Okay, I'm going to go ahead and close the poll. 46% of our respondents said they're not sure. 21% are experienced and looking. 19% have never done a deal but are actively looking now. And then the remaining 14% fall into that intrigued category.
Okay, well, let's see if we can give you enough information to where you can decide whether or not you should be pursuing this today. So let's go back to our case study. In this case, the acquiring firm, the target firm, is a firm that has 6 partners, about $7 million in fees, so roughly about 3 times the size of our selling firm. 2 of their partners will be retiring in 4 to 6 years, respectively, and that's important because oftentimes the seller in a transaction like this is looking at the firm saying, well, wait a minute, you've got old people too, they're going to be retiring. Why would I sell into a firm to take over for me when it looks like you have the same problem? And I think the key here is the next bullet point is that this firm has 4 partners in waiting on the bench. So that the issue is important, and we'll get into this even a little bit more further down into the webinar. It's important to understand the capacity that an acquiring firm has, especially when it's firms of this kind of size. I mean, if we were talking to a $200 million firm, we probably wouldn't have this concern. But with this size, 2 firms that are relatively similar in size, this is an issue. It isn't as important to know that they have 2 partners retiring in 4 to 6 years. It's important to know what are they going to do about it. And in this case, they have a plan in place. They have a strong bench. And therefore, looking at that in more detail is what the seller needs to do to get themselves comfortable. The firm knows it needs to promote these 4 partners, but quite frankly, the partners are a little bit reluctant to do it without more business because they're afraid it would dilute their profit pool. So this firm is looking potentially at an acquisition as a means of promoting growth and promoting room to promote their 4 partners in waiting to partner status and therefore securing their future succession. You know, the standard goals that most firms that are in the acquiring mode have for a merger are basically to grow, and they're looking at sometimes just pure growth in billings. The feeling is that if I've got a $7 million firm and I can grow it to $10 million, that's going to enhance the value for all the partners in the firm. It's probably going to enhance our stature in the community, maybe move us up several spaces on the top 25 list in the community and so forth. In addition to that, looking for specialized talent and services, sometimes looking for a geographic expansion. We've got clients that are in a market and we'd like to have an office in that market, or we'd like to be in that market because we think it's a good opportunity. It seems to be right for the kind of services we offer. Maybe doesn't have a really strong competitive environment. Brand enhancement, which again gets back into that, where do you stand in the top 25 list? You know, the bigger the better. I mean, typically a lot of referral sources are looking at the size of the particular firm that they're referring into. Acquiring clients to cross-sell special services that they already have. A good example of this is if we offer wealth management services and we acquire a firm that's got the right kind of individual clients in it, we've got a very lucrative potential cross-selling opportunity. And then strengthening the succession team, which can come either from acquiring diamonds in the rough from a firm that has younger people that maybe they don't know how to develop and promote, but we do, or in the case of our case study, creating growth so that the talent they do have can be developed further. As we look at the different kinds of deal structures, we're going to go through all four of these. One would be an outright sale. And when you think about selling a firm, this is typically what you think about is, okay, we sell, you know, we turn over the keys, we walk away, somebody pays us something for the firm. Two-stage deals, which are really a technique that we see used more often than any other in the case of a sale. A cull-out sale, which is a specialized situation where, we'll get into that, where we have a potential to sell off part of a firm. And then we're going to talk about what's the difference between a sale of a firm and a merger of a firm. In an outright sale, your purchase payments typically begin immediately. So say we've got a sole proprietor, has a $750,000 practice, this time of year might be saying, you know what, I really don't want to go through another tax season. Somebody take this thing off my hands. So might find a buyer. The buyer would say, we'll get through a quick little transition here, then we'll start paying you for the practice. We might probably pay you based on retention, but we'll start those payments immediately. We're not expecting you to work very much anymore, probably just on a part-time basis. Sometimes that's an issue. How much are we going to pay you to do that? Is it, what are you asking me to do versus how much you're going to pay me? That becomes an economic issue for the buyer, of course. And, the real disadvantage in the example I've just given you is that we haven't allowed a lot of time to transition the practice. So the clients who are all going to be coming in the door probably over the course of the next tax season are going to find out that they're going in a different door. And they're not going to really have time to adjust to the acquiring firm. And so oftentimes in an outright sale where we have a quick transition like that, there tends to be more attrition, more loss of clients than there would be if that practice was given more time to transition. That leads us to a two-stage deal, which is another form of sale, but it's one that anticipates a much longer transition process. Usually, in this case of a two-stage deal, stage one would last for up to 5 years. We don't usually see two-stage deals with longer than 5 years stage ones. Stage one consists of basically the transition period during which the seller is involved full-time or mostly full-time in the practice and continuing to practice and to continuing the relationship that he or she has with the clients that they had before the sale. So they start the transition process. They give the clients several years to acclimate themselves and become acquainted with their the successor firm and the individuals in the successor firm that will be taking over for the seller. During that stage one, let's just say it's 3 years as an example, during those 3 years, the seller would maintain reasonable control over the client base while going through the transition process, would probably take on a principals or non-equity partner role. Usually the seller would not sign on to the partner agreement or owner agreement of the successor firm. And this is really important. Normally would maintain the compensation level that they had prior to selling. So even though they're not an owner in the firm anymore, they have a contract that dictates basically all the important financial aspects of the relationship. And one of those would be a formula type compensation arrangement that would keep their compensation whole as long as the practice remains whole and their time commitment to the practice remains whole. So really this is a merger. in stage one, except there's a contract relationship that's outside the owner agreement that the successor firm has with its other partners. Stage two is the period during which the seller is paid for the practice, the value of the practice. Stage two would kick in typically at a prearranged date. It can happen earlier if it has to, but it can't usually happen later than that time. And at that point, the point in time when stage two starts is when the seller quits working full time. They may continue working part-time on a per diem type arrangement with the firm, but in essence would be no longer considered to earn partner level compensation. And that's when the purchase payments typically start. So the reason why this works economically is the buyer's not being asked to pay for the practice while the seller is still continuing to take virtually most of the profits out of the practice, and the seller isn't being asked to work full time and continue their role for a long period of time while they're making less money, so that the buyer has the incentive to actually start the purchase payment. So we make sure that those two things are separated. And stage two, in this case of a 3-year deal, would start after 3 years. A cull-out sale, and we'll get a little more into a two-stage deal, by the way, because that's one of the techniques we used in our case study. A cull-out sale is where the seller is selling a part of the practice or retaining a part of the practice. So let me give you a couple examples. One would be, for instance, if we have a part, let's say we've got 4 partners and we really can't agree on some major strategic issue. As for an example, succession. One of the partners feels like, I'm just not comfortable that this is going to work out for me. That partner might break off from the firm and go find a different buyer for their part of the practice. That would be considered a cull-out sale. Another example would be one that I worked on in the Midwest, where we had 2 offices. The main office, where I think it was 6 of the partners were located, was the primary headquarters office. There was a smaller community that they had 1 partner in, and that partner was about 4 years away from needing to retire. They didn't feel like they had anybody that wanted to replace that partner in that office. And so we found a buyer in that community for that particular office, and that we arranged for what was in essence a 2-stage deal for the partner in that office, and that in effect was a cull-out sale with respect to the primary firm. Sometimes we're carving off a segment of the client base and selling that off. Sometimes we might be carving off a type of service and selling that off. It might be a specialized consulting service, for instance, that is so specialized that we can compartmentalize it and sell it off with staff and so forth with that. Oftentimes it's a location that is as part of a cull-out sale. But this is a way to deal with taking pressure off of the succession issues. If the firm is just going to be too large for the remaining partners to manage after certain partners have left, then rather than let the thing collapse, we might have an orderly diminishment in the size of the firm through a cull-out sale. When we're talking about a sale versus a merger, the key difference is the ownership status of the selling partners after the deal's done. So in a merger, the partners that are equity partners in the selling firm sign on to the partnership agreement or the owner agreement of the successor firm and become owners. So in essence, what they've done is exchange their equity for equity in the successor firm. Oftentimes people ask me, how are firms being valued in mergers? Well, it depends on who you merge into. So if you're, what determines the value of the selling partner's equity in their firm is the partnership agreement of the firm they merge into. So if it's a firm that uses a 2.5 times compensation arrangement paid over 10 years, then look at your compensation. That's the value you got for your firm. You may merge into a different firm where they use a completely different valuation metric. If it's important to you to know what your interest was worth, that's how you're going to determine it. Actually, that's not normally the most important issue. The most important issue is typically the compensation arrangement that you're going to have with the new firm, what your role is going to be, the culture of that firm, and all the issues that are associated with, to me, the buyout arrangement, which normally isn't going to happen for at least 5 and oftentimes 10 or more years, ought to be much less of an important priority in looking at whether or not a merger opportunity is a good one. But in essence, the key thing here to understand is that the seller's agreement or the buyer's agreement is what dictates the terms in essence for the seller. That'll take us to another polling question. Sorry for the interruption here, but we have to go through these. Nikki?
Okay, the third polling question is on the screen now. This is about the next 5 years. Is your firm most likely to acquire a smaller firm, merge with a similar size firm, merge into a larger firm, sell, or you're not sure? We'll leave it open for about 15 more seconds. This is the third polling question, and you do need to do 3 out of the 4 in order to get your CPE credit. Okay, I've just closed the poll. Terry, 49% say they're not sure. 20% indicate that they're most likely to acquire a smaller firm. 13% sell. 10% merge into a larger firm, and 9% merge with a similar size firm.
Okay. Let me just comment for a second about merging with a similar size firm, and I'm not discouraging you from doing it. I'm just trying to keep your eyes open. When you merge with a similar size firm, in essence, everything is on the table, and everything has to be dealt with. So you have to, you don't know what the default answer is for virtually everything. Now, this isn't always the case. I mean, the firm may be similar size, but the parties agree that one firm is in essence going to be the successor firm. But oftentimes what we're dealing with is we need to come up with a new owner agreement. We need to come up with a new compensation arrangement for the partners. We need to decide who's going to be in charge of certain divisions, certain parts of the practice, who's going to be managing partner, and so forth. So a merger of equals is, quite frankly, oftentimes the hardest deals to do. And if you can think about the mergers you've heard that have been announced that never happened, oftentimes through large regional firms, this is what happened behind the scenes, is they needed to get the word out because it had leaked that they were in discussions, and so they announced the merger before they had these issues worked out, and they couldn't work them out. So just a word of warning with mergers of equals that they can be probably the messiest, sometimes the messiest way to go. So let's get back to our case study. Frank, remember, was the oldest partner, and Frank was 3 years out. We, in essence, put together 3 separate deals in this case, and Frank's deal was a 2-stage deal. We'll go through in a second what the details of that were. Alice, on the other hand, was admitted as an equity partner in the acquiring firm. And Dan, unfortunately, at the moment, didn't have a large enough book of business that he could be justified to be brought in as an equity partner in the successor firm. Instead, he was admitted as an income partner, but given a clear path to equity if he can show that he can manage enough business. Now, one of the things that would help Dan in this case is part of Frank's practice would probably be given to Dan, or he would be given the opportunity to manage part of Frank's practice and become Frank's successor to a certain extent, which should help Dan develop enough business to where he could be considered an equity partner in the firm. But up front, a $300,000 partner wasn't going to cut it for the acquiring firm. The parties agreed that, in essence, we really were dealing almost like we had 3 separate books of business here, or maybe 3 sole proprietors. So therefore, everybody's books of business could dictate how they were dealt with in the deal. Now, keep in mind that in Frank's case, his equity was 70%. He was managing roughly about 60% of the practice. So there was a little bit of a difference there that had to be dealt with. But in order to get the deal done, he was willing to accept the difference in his buyout. Where we typically run into problems like that is when we might have, a partner who, according to the books, owns 70% of the practice, but only manages, say, 30% of the clients. Is only being paid 30% of the compensation. So there's an imbalance in what operationally is happening versus what they think the equity allocation ought to be, and that's where we have to get very creative sometimes in how to overcome the perception of how value should be allocated versus what's really happening, in the field. So Frank's 2-stage deal was during stage 1, which was set up for 3 years, which is when Frank, wanted to retire, or at least go into part-time status. His comp was set up as on a strict formula of 35% of the collections from his client base, from his book of business. You know, there was ways to adjust that in the event that he cut back his time, so that you know, if we had to use more labor to support his practice than what he historically had used, that there would be an adjustment in the compensation rate that he was paid to account for that, so that the acquiring firm wasn't out of pocket. And certainly the volume issue was automatic because it was tied to the collections from his clients. If the client base, you know, if he lost clients, then of course then his compensation would go down on a pro rata basis automatically. It also provided him an opportunity to, or incentive to, create growth within his client base. Usually in these cases we have a separate new business development bonus that's not part of the core practice or core book of business. One of the things you want to try to avoid is Frank bringing new business in and then bonding with those new clients and managing them, and then soon thereafter all of a sudden leaving. So typically the new business that Frank would bring in would not be assigned to him. It would be assigned to somebody else, and therefore it wouldn't be appropriate to pay him as if he was managing it. And therefore we usually set up a separate kind of new business incentive that's maybe 10 or 20% of collections over 1 or 2 years. You know, Frank's primary objective was to smoothly transition his clients to the new firm in order to maintain the value of the practice. So he maintains the client relationships. He continues to manage those relationships and gradually backs away and gradually introduces a successor within the firm to those clients, so that the day that Frank leaves or the day he retires or goes to part-time status, it's a non-event. Everybody's already made the transition. They already know what's going on, and Frank, you know, going into that role doesn't really cause anybody any problems. You know, all the while he's doing this, he's maintaining his income because he's working full-time. He's just changing his role gradually over time. And Dan and some of the other partners in the successor firm, and potentially some of these newer partners in waiting in the successor firm, would become Frank's successors to his clients. Stage 2 is when Frank, you know, reaps the benefits of selling the practice. Now, in this case, Frank was allowed to retain 70% of the firm's AR and WIP at the beginning of the deal. We're seeing more and more nowadays, because of issues related to obtaining credit, and also because, quite frankly, firms are a little more focused on cash flow, that oftentimes the selling firm might be asked to let the successor firm use the AR and WIP for 1 or 2 years, and then, you know, to help kind of ease in the cash flow issues. Keep in mind, in this case, there's $560,000 that Frank has in ownership of AR and WIP, and that's cash flow that the successor firm would have to come out of pocket for. So if we can kind of spread that out, it might make it a little easier to do. But in this case, Frank was allowed to keep his portion of the AR and WIP up front. He was paid based on the collections from his clients over 6 years in stage 2. Again, remember those payments don't start until Frank goes into stage 2 after 3 years. It replicates, in essence, the kind of deal that Frank would have gotten had he done an outright sale from the very beginning, except this is a stage deal. It's a smoother transition. And again, as I said before, Frank would be paid separately for any new clients he helps develop. Now, when you think about what creates value in an accounting firm, it's all about the transition of the practice. I mean, we can sit here and say, well, let's negotiate the best deal we can, let's get the best terms we can get, and that's what's going to create value. The reality is that if the clients aren't maintained by the buyer or by the acquiring firm, the value is going to be lost. Very few deals are done on a fixed price basis at closing. There's just too much risk associated for the buyers, and when those are done, they're typically with very, very small practices, and oftentimes, quite frankly, with buyers, they're inexperienced. And so usually you're going to have a significant amount of potential for adjustment in the price if the clients aren't maintained. So the most important issue is to create a business plan that successfully is going to transfer the loyalty that clients have to the seller to the buyer. When we think about the terms, or we think about the value of a practice, there are 5 primary factors that make up within the terms that in essence create the value. One is the amount of cash up front. Oftentimes this is dependent on the time of year. So for instance, if a practice is sold, let's go back to an outright sale type arrangement. If a practice is sold in December, where the buyer now has the opportunity to anticipate good cash flow during tax season, the seller might receive a larger down payment than if the practice was sold in May, when the buyer's looking at it and thinking, well, I'm going to be lucky to break even for the next 8 months. How well the deal cash flows. I mean, how well the clients are paying their bills, and what kind of cash flow is created from the overall business plan has an impact on how much cash the buyer might be willing to pay up front, and the treatment of accounts receivable. So again, where you're asking to cash out the accounts receivable up front, you might see a lower down payment on the purchase payments, whereas if the seller was willing to let the buyer use those receivables for a year or two, they might be more willing to increase the down payment up front. Typically in a 2-stage deal, we don't see down payments. Normally you wouldn't have anything paid at closing, which is the beginning of stage 1. Sometimes there's a bonus paid at the beginning of stage 2, but oftentimes there's not in those cases. So normally where we see down payments is usually in outright sales. The treatment of the retention clause, how contingent the deal is on the retention of clients. It's very rare to see fixed deals, as I've said before. There are a few examples where that happens, but it's very rare. Normally there's some kind of a retention period that runs anywhere from 2 years up to the full period of payments, as long as it's not more than 5 or 6 years. I mean, if it's a 10-year payment deal, normally it wouldn't be contingent for that long, but typically say 2 to 5 years on the retention clause. A limited guarantee would be one that might be a 2-year retention clause as opposed to a 5-year. And an economy clause says, in essence, okay, for a while we're going to be contingent, and then beyond that, we're only going to adjust the purchase price if the client leaves for a reason that they would have left the seller for as well. So for instance, if the client goes out of business or sells their business, then that might be an adjustment to the purchase price, even though the rest of the deal has locked in. And sometimes we'll use that for particularly large clients. So if we've got a $2 million practice and we've got a client that's a $500,000 client, we might put an economy clause in place to protect the risk that one client presents. The profitability of the practice is a third term, third primary factor. Part of this is related to the seller's current profitability, but it's more important for the buyer to anticipate what the profitability is in their hands. So to give you an example, say you've got a sole proprietor, a very small practice, say a $300,000 practice, and we've got the sole proprietor works out of their home. This person's wife answers the phone and acts as receptionist, is unpaid for doing it, has very little overhead, maybe has an 80% profit margin as a result of the way they operate. Well, let's say that person all of a sudden decides, you know what, I'm tired of working out of my home, my wife's tired of working in the practice, so I'm going to move into an office and I'm going to hire somebody. And all of a sudden their profit margin becomes more normal, or say it's around 40%. At what point in time was that practice worth more or less to the buyer? Of course, the answer is probably it's the same. So it really isn't how the seller was operating. It's more important to look at how the buyer would operate that practice. And a more normal profit margin of around 40% or 35% would be what the buyer might anticipate the profitability of the practice to be. So when you're looking at the profitability of a practice, it's important to consider, as a buyer, to consider, how profitable it will be in your hands. The tax ramifications of the deal makes a difference. If it's a goodwill deal, it has to be amortized over 15 years. That's not as lucrative for the buyer as a deal that might create a current deduction that's in the form of a consulting arrangement. And then the length of the payout period also makes a difference, of course. And this is primarily not an issue, in my mind, of credit risk. It's more of an issue of cash flow. So if we've got a deal that's paid completely over 3 years, at say one time, so that's 33% for 3 years, if the practice was generating a 40% profit margin, there's not much profit in that deal. On the other hand, if we were paying it over 10 years, at 10% a year for 10 years, and again, I'm not saying it's contingent for 10 years, then needless to say, that's a significant amount of cash flow on the part of the buyer. So the length of the payout period can make a big difference in terms of how profitable the deal looks in the buyer's hands. Well, the multiple should be the effect of all those other four. So for instance, if you have a low down payment, you've got a long payout period, you've got a tax treatment that is favorable towards the buyer, for instance, as treating the deal as a consulting arrangement, and your retention adjustment is for a somewhat significant amount of time, say if it's a 5-year deal, over 5 years, then the buyer, in that case, should be willing to offer a higher multiple on the deal than if all of those terms were the other way around. So this is the interplay between these terms can have an impact on, if you define value as the multiple, can have an impact on the multiple and therefore the value of the transaction. So with that in mind, going back to our case study with Frank, again, because it was a 2-stage deal, wasn't paid any down payment. He was in essence paid a 1x deal, which is 1x divided by 16.67% of collections. That was only applied for the first 3 years. And then we locked the price in after 3 years based on what was actually had happened in those first 3 years. In the remaining 3 years were a fixed payment. So he had a limited guarantee in his deal. And in this case was treated, 50% of the deal was treated as an asset sale, meaning we allocated 50% of the purchase price to goodwill, and 50% was treated as a consulting arrangement. So that was kind of a compromise between the buyer and seller in terms of the tax treatment in order to make it a little more lucrative for the buyer. Alice, on the other hand, signed on to the successor firm's partner agreement. She was conditionally guaranteed that she would maintain her level of compensation at $275,000 for the first 2 years. The condition was that the practice, her $800,000 book of business, had to remain intact. And they gave her a cushion. They gave her a 5% cushion. So had her business dropped, her client base dropped below 95% of $800,000, then there would have been an adjustment in her compensation. That contingency also applied to the equity that she was allocated from the successor firm, which was about 8% in this case, which is really a pro rata, kind of what her revenues were relative to the combined whole. She contributed her AR and WIP as a capital contribution, and she got back under their partner agreement when she retired. Otherwise, she became bound by all the other terms and conditions of the successor firm's agreement. Dan signed on as an income partner. His base compensation was pegged at the $150,000 when he came in. He became eligible for bonuses consistent with the other income partner status or program that they had with their other income partners. His share of the AR and WIP was actually held by the firm, and eventually he would be paid for that if he didn't become an equity partner. If he did become an equity partner, that would be used, in essence, as his capital contribution. And the hope in Dan's case was that he would become an equity partner within 2 years, but he had to prove that he was capable of managing a larger book of business. With that, we're going to move to our last polling question. Turn it back over to you, Nikki.
Okay, thanks, Terry. The last polling question is up on the screen now. This is the most important thing in your mind for M&A. Is it the financial terms, the cultural fit of the parties, or retention of the acquired clients? And we'll give everyone just a few seconds to select this. Again, it's our 4th and final polling question of the day. All right, I've closed the polling question. We've got a fairly even split here. 40% of folks indicated retention of clients, 36% cultural fit, and 24% financial terms.
Okay. And for me, I think so it's probably why we had kind of an even split there. Okay, so if you're a seller or a potential seller, I think ask yourself what defines the right buyer. What I would suggest is that you remember the 4 C's, and those are culture, chemistry, continuity, and capacity. So culture And I like to think of culture, when you think of culture, everybody says, yeah, the cultural fit's got to be, but then people have a hard time defining what that means, and they have a hard time defining, when it's right and when it's wrong. It's kind of a look and feel kind of thing. And reality is, the way I think you should look at culture is, ask yourself 3 questions. What's it like to be a client in this firm? What's it like to be an employee in this firm? And what's it like to be a partner in this firm? And as you think about those things, you get into some operational issues that help you understand the culture. So for instance, an example, what's it like to be an employee? How many hours am I expected to work? How many hours am I expected to work during tax season? Those are cultural issues. And if you're working in a firm now, or your people in your firm say are only working 55 hours a week during tax season, and they're only expected to generate 1,400 billable hours a year, and you're merging into a firm where they work 80 or 90 hours during tax season and they're generating 1,800, 1,900 billable hours a year, there's a huge cultural difference there. It's going to be difficult for your employees to assimilate to that firm. Partner status. I mean, if you're in a firm where, I remember once when I was practicing as a CPA, and we were a 4-partner firm, and we were approached by a large regional firm. And the managing partner of this large regional firm, which was made up of about 25 offices, by the way, personally billed all the 1040s in the whole firm, because he didn't trust his partners to bill those 1040s enough. Well, needless to say, that was kind of a dictatorial type environment, one that didn't appeal to us. We never went we didn't get past the first meeting. But that's a cultural issue in that firm. How you're governed, how you're managed, who you're reporting to, are all issues about what's it like to be a partner in this firm. So ask yourself those questions, and it'll help you get through the culture question. The chemistry, I think my partner Joel Sinkin says this the best. When you're sitting across from somebody in the initial meeting, if you can't see yourself having lunch with this person on a regular basis, in other words, you just don't like them, you're not really hitting it off, don't go any further with the conversation, because chemistry is important. You've got to enjoy going to work. You've got to enjoy being around the people that you're going to be around all the time. So you're around people at work more than you are your spouse typically. So chemistry is important. Continuity is looking at how much change are we going to have to go through in order to assimilate to this new firm. And when you're thinking about this, think more about the things that we call in front of the door, the things your clients are going to experience as a difference, as opposed to the things that are behind the door, which are the things that the employees and partners can. You can adapt to those things. Your clients don't care what tax system you use to prepare tax returns. But if a client's experience is going to change dramatically, it may affect whether or not they want to stay with the firm. And then finally, capacity, especially if you're a succession-driven seller. The firm's got to have the capacity to replace you. And if they don't have it on board now, that they have to show the ability to get it. So it's important to look at the capacity in succession-driven deals. Of course, if you have certain specialties or technical skills, that have to be replaced, those need to be addressed. The size of the firm can be an issue, although I don't really think I think it's overplayed sometimes. I've seen very, very large firms that have fantastic cultures for smaller practices that merge in, and I've seen small firms that have horrible cultures for firms that are not too much smaller than them to merge into. So size is somewhat of an issue, but not usually. I think it's overplayed. Location, of course, if you're going to be asked to move, is an important issue, and then how much technology are you going to have to adapt to that you don't have now? You are what you are. Can't put lipstick on a pig, but however, there are some things that you can do to make your practice more appealing and easier to do a deal with. Buyers hate inheriting problems, and they hate inheriting poorly run practices. So one of the things that I would suggest is, if you've got a lot of old AR and WIP on your agings, get rid of those. Do the things that you weren't willing to do and write them off before. Present your partners and staff in a positive light. I can't tell you how many times we've started conversations where the managing partner kind of throws everybody else under the bus in the first conversation, and then later on in the deal, when everybody reacted to that and said, well, so-and-so's not very good, and so this is what we're doing with them. Oh, what do you mean? We could never do that to so-and-so. He's terrific. So present everybody in a positive light. If you've got problem staff, don't expect the buying or acquiring firm to fix that problem for you. Fix it for them. Clean up the office. Eliminate the clutter. Provide good time records. This is a big issue. Larger firms manage their practices through their time and billing systems. If you don't keep time records, that can be a problem, especially if the managing partner doesn't keep the time records, because that's an indication that he's kind of above everybody else. So provide good time records if you can, and be willing to part with unprofitable clients. Sometimes let's say you do 1,000 1040s. A lot of larger firms don't like a lot of 1040s. If half of those 1040s are all very small, cheap 1040s, potentially at least be flexible about walking away from that part of the practice or being aggressive about raising the fees. I think you'll usually find that that portion of the practice isn't that much of the volume anyway, and it looks worse, it looks bad, and if you're willing to say, look, I understand you may not want this, let's work together on how to deal with it. Or let's say you do a lot of or several low-end audits, maybe for not-for-profits that are clearly not profitable. At least show flexibility that you're willing to walk away from that part of the practice. If you're a buyer, keep in mind that if it's an acquisition, and a two-stage deal is an acquisition, this should mostly be about the client you're acquiring, the staff you're acquiring, and the economics of the deal. You're not creating a long-term partner relationship with the seller, so don't worry so much about cultural issues. It's not a merger. It's an acquisition. You're going to be sharing space for a limited amount of time. On the other hand, if it is a merger, then culture becomes a very important issue. Go back to my 3 questions. What's it like to be a partner in this firm? What's it like to be a client? What's it like to be an employee? And walk yourself through those important issues and ask yourself, is there a good fit here? Does this firm look like it can assimilate into our firm? For acquisitions, the most important thing that a buyer can tell a seller is the most important thing for me is I'm going to keep your clients. Sellers are scared to death that buyers don't want all their clients, they're going to cherry pick them, that they're going to do something that's going to run all of them off and they're going to lose value. So oftentimes just saying that it's really important to me that we find a way to keep all of your clients will help a seller become much more comfortable in the conversation that you're having with them. Try to minimize change, especially up front. Some things you have to change, some things you can stage over time. Sellers hate change. So it's not that I'm telling you not to change. What I'm saying is be sensitive to the fact that not everything has to change on day one. And terms, be careful what you wish for. Sometimes the practice that you think you're getting very cheap, there's a reason why it's cheap. Either it's a low quality practice or the seller, quite frankly, isn't motivated to maximize the value, which means that it may not be a practice you want to acquire in the first place. So be careful of very cheap practices. What makes you an attractive buyer for the seller? If in a merger, the owner agreement's everything. So if you don't have an owner agreement, it's going to be difficult to merge another practice in. I'm dealing with a situation right now where we have an owner agreement. It's a merger, but the acquiring firm was in the process of changing it, and we're kind of dancing around the need to close the merger. At the same time, we're going to be changing the owner agreement. So it's been a bit of a challenge to get that done, and we're going to get it done, but it made it much more difficult. Be prepared to be clear about your compensation system for partners. Keep in mind that if your system depends on a lot of subjectivity, for instance, a managing partner or an executive committee that is making most of the decisions about partner comp, that the reason why that works in your system is because your partners trust each other and have been around for a long time and know how to trust each other and what to expect. Asking someone to come into that system and trust a subjective system can be difficult. So I'm not saying change your system for them, but that's where things like 2-year compensation guarantees help kind of bridge that gap. Also, being willing to show them, based on your current performance, this is how we would expect you to get paid. This is how partners like you get paid in our firm. Making as much clarity as you can in the compensation system. Demonstrating long-term strength, especially with respect to succession. If it's clear that you have older partners that are also going to be facing succession, be ready to talk about how you're going to deal with that. Don't dance around it. And being able to present a lot of upside potential for the merging partners. For more information on a lot of these issues, one of the sources I'd like to direct you to is the AICPA Succession Planning Resource Center. You'll see that we have provided a lot of information for. You'll see the link here on that. That's a picture of my partner down there, Joel Sinkin. That's where you can get a lot more information about succession issues. I'm also a member of the CPA Consultants Alliance, which is a group of, it's this group of people that are actively providing different kinds of consulting services to the CPA profession primarily. We've issued 3 white papers that you can download at the at CPAConsultantsAlliance.com on CPA firm leadership, measuring happiness, and then one that we just completed on succession issues in CPA firms. This was based on a survey that we did nationally of, we had about 400 respondents to our survey. And in fact, at the end of this presentation is that we're not going to go through now, but is in your downloaded copy of this presentation, is a summary deck of that succession survey report. So I think you'll find a lot of interesting information in the slides that follow this presentation. If you're interested in other webinars that we've done, you can view downloaded or webinars that are on our website. Here's some examples. There's actually several dozen of those on there. Roadblocks to avoid an M&A accounting firms we presented last November, and you can go through the list here of other webinars that are available. Now, you wouldn't be able to get CPE as a part of downloading those, but they would provide valuable information to you. And with that, I'm going to turn it back over to Nikki, and I think we've completed the webinar.
Okay, thanks so much, Terry. We did have a few questions come in. Would you like to address those over email since we're nearly out of time? Okay, we've got one of them is the 40% profit margin mentioned earlier, the revenue less overhead expenses that equals partner compensation. So the partner compensation should be 40% of revenues?
That's what I was referring to. And when we talk about profit margin in an accounting practice, we're almost always talking about the profit before any owner compensation and perks and benefits. Okay, and the reason why we do it that way is to make it so that it's comparable from practice to practice, because the amount that the owner is paid is obviously discretionary. Go ahead. So
another question, Terry, was, is the profit margin before or after the partners are paid a salary or guaranteed payment?
It would be before any partner compensation or guaranteed payments.
And then there was a question earlier that had to do with the case study. It says security or guarantee does Frank get for the 6-year payoff in stage 2? And that may have come in before you addressed it.
I understand. You're dealing with, if you're looking for some kind of collateral, it's unlikely that any collateral would be given to secure the payments. I hardly ever see that done. What typically, you ask yourself, well, where's the seller's recourse? Well, keep in mind, as you're dealing with a $7.5 million firm that has, in this case, it'd be after the merger, a $10 million firm that has, 8, 9 partners whose livelihoods depend on the future of that firm. There's certainly some things that we can put in place that will accelerate the payments or do other things in case the firm merges, or in case the firm goes through. Keep people from taking business away from the firm and so forth. But typically it's an unsecured debt from that firm, but it's one that it's rare, extremely rare, that isn't paid off. I can't think of any deal we've ever been involved in, and we've been involved in almost 1,000 deals over the last 20 years, where there's been a default in the payments, for other than maybe disputes that occur from time to time, but never because of a firm actually collapsed. I can't think of any transaction that ever happened like that.
Okay, we've got 2 questions if you want to pick one, or maybe you have time for both. One is, are you seeing more sellers or buyers in the market? And the other one is, what is a realistic timeline to close an acquisition once you've identified a firm to buy or sell?
The second question is fairly easy. We can get deals done within 2 months. Realistically, it's 2 to 4 months. Unfortunately, sometimes they take longer just because people don't keep their eye on the ball. But there's no reason why it should take longer than 2 to 3 months once you've started the process. As far as the buyers versus the sellers, I don't think that there's fewer buyers. I think there are way more sellers. And that is definitely changing the dynamics of the market. It's creating more of a buyer's market, so buyers have a little more leverage in terms of deal terms and so forth. And we're finding firms that are in some cases finding it harder to find buyers because the people they normally would have been talking to have so many more options to consider that they have to really be pretty good for them to be considered. So it's definitely flipping towards a buyer's market, but it's not because there are fewer buyers. I think it's mostly because there are so many more sellers.
Okay.
Anything else?
One final question, hopefully this is a quick one. Is 40% the average profit margin for all firms?
I would say it's in the 30 to 40% range is where we find most normally organized firms' profit margins. Now, you know, the larger the firm is, the larger the revenues are per partner, the lower the profit margin tends to be because you have less of the partner's time that is used to produce the revenue, and partner time is free in that equation. But typically most firms are going to fall in the 30 to 40% range.
Okay, great. Well, thanks so much, Terry. We've hit our 1 hour mark and had a chance to answer nearly every question. I thank everyone so much for attending today, and you will receive an email from me later today if you registered through Transition Advisors. That'll have a link to the online evaluation that you'll need to complete in order to get your CPE credit. All right, thanks so much.
Thank you.